Hello and welcome to Analyzing Finance with Nick. And in this video, it's going to be the first of a two-part series about student loan finance, the history of student loan finance, and what can be done to reform student loan finance to make college more affordable. The reason why I'm doing this topic is because I had a question from a viewer, Prachik Panchal, who asked if the government stopped incentivizing student loans, would it lower the cost of tuition? And I think the answer to that is absolutely yes, it would. And I'm going to go to why that is the case, but we first have to go through a history lesson. Really, with college, for the most of its history, it was something reserved for the upper classes of society prior to World War II. And then with the GI Act, it opened up college to a lot of the military who previously would have not gone to college otherwise. It actually probably helped finance my grandfather's path to becoming a doctor after he fought in the Second World War. And it made the university system a lot more just accessible to the general public and led to a much higher skilled and educated population since then. And however, even after World War II, with that increase in new students, the cost of college relative to inflation didn't really start to go up until the late 1970s or the early 1980s. For example, my father went to Santa Clara University and graduated in the year 1976. In 1976, the tuition for Santa Clara University in today's dollars was about $13,000 a year. Today, if you wanted to go to Santa Clara, the tuition, not counting room and board, the tuition alone, is $55,000 per year. So even after inflation, the cost of going to a private university for 4 years has quadrupled almost in the last since 1976, which would be the last 45 years. So why has college cost in the last 45 years increased by fourfold in real terms? I think it's mostly due to a lot of policy decisions made in the late 1970s that we're still really living with today. That's why I use 76 as the benchmark for this. The first one of these is a modification to the Higher Education Act of 1965. The Higher Education Act of 1965 is what create the Guaranteed Student Loan Program, where the government effectively guaranteed most student loans from private lenders with federal funds, which means if I'm a bank and I lend to a student, even if the student fails to pay, the government will either buy the loan off me, kind of like a mortgage-backed security, or they will cover the losses. And this didn't really affect pricing of college much until the Middle Income Assistance Act was passed in 1978, because prior to that, these guarantees were primarily restricted to lower income individuals and families. And Sallie Mae, therefore, business was really only for economically disadvantaged. Well, the Middle Income Assistance Act expanded that to the middle classes, and therefore it made access to student loans a lot easier, because if a bank knows that, hey, wait, if I lend, the government is going to back me, and so they're really not taking any risk, they'll lend as much as they can to the students. And the universities get wise to this, and they're like, hey, wait, why don't we just raise tuition to the maximum amount that the banks legally or are willing to give to the students to pay for university? And so due to this incentive, the universities kept raising prices at a rate faster than the cost of living, because the banks were willing to comply with this. And you see it like in a lot of the universities today. You have generous pensions for academics. You have administrators who are basically paper pushers who run a lot of the departments and the operations of the university outside of actual educating. but these people still get six-figure salaries and pensions. That's where most of the bloat in universities is going. On top of that, they also use a lot of the money for constantly renovating buildings and making the universities a nicer place to go to college, so that it justifies the higher costs. I call it the Bloomberg terminal business model, where they, instead of lowering the price, they'll just make the product better and more luxurious until they think they can justify it. Like an example is there's a lot of universities that have really nice recreation centers where they have jacuzzis and state-of-the-art fitness centers and racquetball courts. I know I had all this in college, and it was quite enjoyable, actually. Or the dorm rooms are a lot more upscale than they used to be, or the dining commons has better quality food than they used to be. So they just make it they renovate the classrooms on a frequent basis, so they're all state-of-the-art and really modern and nice. And that's where a lot of the money goes to too. The university reinvests in itself to make it a higher end product so that they can justify the higher prices. And so this spiral is what caused college to accelerate the way it did. Like, again, prior to these changes to the student loan laws, you had college basically be affordable to pay for with either a summer job or working through school. Even the private school is $13,000 in today's money. That is doable. It's not easy, but it's doable to pay for that while working, or at least get most of it out, so you have a very marginal student loan, if any. Whereas today, somebody with a pre-college skill set at the age of 18, forget about it. They can't pay for a private school tuition on a summer job, not even close. In fact, if they're unfortunate, their first year salary out of college may even be less than what they paid in tuition. So there was one other thing also in 1976 which was a critical to the student loan legal system, and that's basically when federal student loans in 1976, so when Congress amended the Higher Education Act 65 again to make student loans unforgivable in bankruptcy. And so they have the combination of loans that cannot be wiped away in bankruptcy and a government guaranteeing them. It created all the moral hazard that the financial system needed to basically max lever students, because they become a captive market, and the downside risk of these students not being able to make enough money to cover their education costs was wiped away. And so this creates bad incentives, and it created a spiral higher in college prices. So that's the economic history of why student loans are high. It's basically a combination of government guarantees to banks to lend money and the inability to discharge the loans in bankruptcy were the main two catalysts for this. And also you had demographic factors which favored it too, such as the millennial generation going to college. Now a lot of these things we've kind of hit a limit, and I'm going to do in the next video some solutions on how to fix it, but I think the market is already starting to correct for this somewhat. You're seeing it indirectly through lower birth rates, because student loans are preventing a lot of younger people from getting married and starting families and buying a home, and so the college classes now are smaller, and so there's less demand for the universities. And then on the other side, the costs have turned off a lot of people from going to college entirely, especially with wages going up for lower skilled labor in the last 4 to 5 years. So those are maybe driving people out of the system, but there's also things that we can do from a policy perspective and the universities can offer from a market perspective to fix this problem too. If you like these topics that I go more into a specific niche industry and try to figure out the financial incentives that operate it, feel free to have any more suggestions. Please, if you like this, what we're doing here, like and subscribe and share content with your friends and other people you think would be interested. Growth really helps us get our content out there and inform and educate more people about the world of finance in an in-depth and nuanced way, which is not very common here on YouTube. You can also email us at askafundmanager@gmail.com for specific questions you may have. about anything, other specific topics, or just your feedback overall about our channel. Thank you for watching, and good luck out there in the markets.